Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump says he does not plan to fire Fed Chair Powell, but the back and forth is leaving Fed independence hanging in the balance. We'll discuss. Plus, tariff talks. The EU trade chief heads to Washington in search of a tariff solution. And earnings season rolls on. We'll get insights into some of the top trenders of the session. Let's get a check of the markets first of all here. The three major averages all in the green, at least for the moment here. The Dow up about 140 points, about a third 1%. The S&P up 0.25%. The Nasdaq up about 0.4%. So we've got modest gains here following the Fed whipsaw that we saw yesterday in the markets. Today, a lot of focus coming back to earnings, including awaiting some after the bell, Netflix most notably. In the bond market here, where are we going today? We had retail sales this morning coming in better than estimated. We are seeing yields come down a little bit at the moment. 4.43% is where we stand on the 10-year. We've had a little bit of up and down this week, but really it's remained in a range. Well, President Trump telling reporters Wednesday he is not planning to fire Fed Chair Jay Powell, but he qualified it later, saying he doesn't rule anything out, and Powell could have to leave, he said, for fraud. The source of a lot of Trump's frustrations toward Powell is the Fed Chair's wait-and-see method when it comes to rate cuts. New York Fed President John Williams supported the current policy stance, saying last night it is, quote, entirely appropriate. Joining me now on the ongoing saga is Nick Timmeros, the Wall Street Journal chief economics correspondent, and Stephanie Roth, Wolfe Research chief economist. Thank you both for being here. Nick, let's start with you, because as you wrote about this morning, the president's latest reason, or excuse, if you will, for sort of casting aspersions on Jay Powell is the Fed building itself and the ongoing construction project to renovate it. What do we know about that project, and is that really what this is all about?
That's not what this is about. This is not about building costs. The Fed is renovating two historic office buildings, one that's been vacant for a while. It's very expensive. Nobody disputes that. There have been cost overruns. Nobody disputes that. But this has been in plain sight for more than 2 years. There have been construction cranes on the Washington skyline. Anybody who drives down Constitution Avenue can see this. This is the 7th year of this 9-year project. I wrote about it in the Journal 2 years ago. So this is not really a fight about building costs. It is a fight about Fed independence. And Julie, as you noted, John Williams isn't the only one. There are a number of Fed officials besides Jay Powell who do not want to cut interest rates at the June meeting. So this is about the president being unhappy that he is not able to get lower interest rates. He is unhappy that he is not able to replace Jay Powell easily. He's basically said he's going to have to wait until the term ends next year, or he's going to have to do something that markets may not like, which is replace a Fed chair. We haven't seen that since Paul Volcker became Fed chair in 1979 under a very delicate set of circumstances where they had to shuffle the ineffective Fed chair over to become the Treasury Secretary. So this is really not about buildings. This is about the institutional arrangement of an independent central bank in the United States.
And Stephanie, a lot of the thinking around what happened yesterday was that this was sort of a trial balloon, that the administration was floating to see how the markets would respond. Is there any world in which markets would not respond negatively to something like the administration pushing out the Fed chair?
No, it certainly shouldn't. Granted, yesterday's price action was a little bit more modest than I might have anticipated, and certainly I would anticipate if we see them following through. We should start to see significant dollar weakness if this happened. We would see significant equity weakness as a result, and I would imagine that Trump might sort of change his tune to the extent that it was a trial balloon. They did get the market reaction that one might anticipate, but it certainly wasn't that severe, and then of course he walked it back sort of in the middle of the day yesterday.
And the other thing is, Nick, even if somehow, the administration tried to fire Powell, it seems like now they're trying to sort of ratchet up public pressure against him. Is there any circumstance, I mean, you've covered the Fed for a while, you've covered Jay Powell very closely. Is there any circumstance under which you think he would leave, maybe not voluntarily, but under pressure?
No, there's not. I wrote a book about the Powell Fed that came out a few years ago. in the book, I have something that Powell said 6 years ago. He said he would never, ever leave the job voluntarily under no circumstances whatsoever. The only circumstance in which he saw himself leaving the Fed was if he died. It doesn't get more absolute than that. And again, this doesn't seem like it, somebody might say, well, gosh, what an ambitious person. What is with this guy? Well, what's with this is he is trying to protect the freedom for his successors to be able to control inflation by having the credibility that the Fed will be able to do an unpopular thing if the circumstances warrant. What would be unpopular? Well, they did 525 basis points of interest rate increases when the staff was saying you're going to have a recession here, and they kept hiking rates 2 years ago. So that's what this is about. And that's why I don't think Powell would go. They may be putting a lot of pressure on him here to try to get him to resign. I don't think that's going to work at all. But they could also be trying to build a pretext here for a for-cause dismissal after the Supreme Court in May strongly hinted that they wouldn't allow a Fed governor to be fired over a policy dispute. So it's entirely possible that's what it is here. You may have a faction inside the White House that wants to try to create an opportunity for Trump if he gets angry enough. I mean, let's say they don't cut interest rates at the next meeting, which they're very unlikely. Looks like they're not going to cut interest rates in July. So, what if the Senate goes into recess and you could you could try to fire the Fed chair and appoint someone into that job? I don't know what they're thinking, but it seems like there are a number of different ways this could go.
And then what does Powell do in that situation?
Well, I've reported that, the Fed was prepared to challenge his removal, or Powell was prepared to challenge his removal in the first term when this came up. So, and I think everything Powell has, his body language has certainly suggested that he believes very strongly in central bank independence. He won't be complicit in degrading that independence. If other people want to take the Fed down, put the Fed into the Treasury, that's going to be in their name. He is not going to co-sign on that.
Stephanie, all of this going on, even with Powell sort of being the bulwark against the erosion of Fed independence, is it done now? Once he's stepped down from that position and President Trump has appointed someone, can the market still rely on an independent Fed?
Yeah, I mean, we have to remember that it's not just up to the chair, and Trump is only in the next year or so going to be appointing two members to the Board of Governors. So it is vote by majority, and he's not going to be controlling all of that. So yeah, maybe at the margin, if he puts in a more dovish chair, that will influence their decisions to be slightly more dovish. But I don't anticipate there will be a massive shift on the backdrop for the Fed, because it is a very credible group of FOMC members that are going to be in charge of voting. And yes, there might be a slightly more dovish bias from the top, but I don't anticipate that will change the direction, in which case then the market shouldn't really treat it that way either.
So, Stephanie, what do you think the Fed should be doing on rates? We got a retail sales report this morning that came in much stronger than anticipated. Does that show us that people are spending even in the face of higher prices? Or, since it's not inflation adjusted, like, what's going on with the inflation feed through there?
Yeah, so when you do adjust the print for inflation, you're at a 0.117 on the control group. Control group is what's key to look at, because it strips out a lot of volatile categories. That was still fairly firm. There were some downward revisions to the prior prints, but when you zoom out, I think the main message here is that the consumer is fairly resilient. Spending should be okay through the back half of the year, and the Fed's unlikely to cut in September either, in our view. So the pressure on the Fed may actually just continue to mount. Base case is the Fed doesn't really cut until the next Fed chair is put into office in May, or at least the conversation is put into office in May, in which case it happens sort of in the middle part of next year. So I think the economy is strong enough and inflation is likely to be sticky that the Fed's not going to be cutting till towards the middle of 2026.
Which means we're going to get a lot more commentary from the White House between now and then. Buckle up. Nick Timmeros, thank you so much for being here. Stephanie Roth, you're going to stick around with me for a bit. We got much more markets action coming up. We're going to talk about the tariff landscape next up. President Trump said Wednesday he plans to set a blanket tariff rate of either 10 or 15% to 150 nations. That announcement comes after the president sent roughly 24 letters to various trade partners outlining new tariff rates that would go into effect by August 1st. Countries have just over 2 weeks to negotiate deals with the U.S. until that deadline. Here to discuss with us once again is Stephanie Roth, chief economist at Wolfe Research. And I should say, Stephanie, as we look at all of this, the president seems entirely content to just leave those 10 to 15% rates in place. He no longer seems to feel any urgency to negotiate those deals by the deadline. What are the implications of all of this?
Yeah, I mean, when we run it on our economic numbers, we had run a number of scenarios. We looked at our, the best case scenario, the middle case, base case, and then the worst case. Then what happened towards the end of the last week is what we had counted for ended up moving worse than our worst case. So now we're talking about potential GDP headwind of something like 90 basis points. So if your GDP was going to be 2%, now it's going to be close to 1%. We think we'll ultimately settle somewhere in the middle, and we'll revert back to our base case. But the rhetoric might get worse before it gets better again. The markets, the inflation data have largely given Trump the ability to press harder on this, and he can further push. But I think eventually that will all come back around, and we'll end up somewhere with about a 50 basis point headwind on growth.
And how long does that headwind last? I mean, if the tariffs stay in place, is that just almost a permanent pressure point there?
No, what you'll see is that this year you'll see growth lower than what it should have been, all else equal. And then next year, because the way we measure GDP is in growth terms. So you have a one-time shock, you feel the impact of that growth, and then you can kind of move on from there. Consumers tend to adjust. They just have to sort of adjust their levels of spending, and it's kind of a one-time shock to GDP. And then next year, you can actually start to benefit from the stimulus that's getting put in place. So this is a lower growth for 2025. 2026 might actually end up being a decent year.
And what do you see in terms of pricing power on the parts of companies to sort of pass this stuff through?
Yeah, and that's what we're starting to learn over the course of certainly this past week, because we got the CPI and PPI data. And there was a question about whether companies had the ability to pass it on. And what we did start to see this week is some of the goods that received significant tariffs did start to see some rises. So in a way, this is good, at least from a company perspective, because it tells you it might not all fall into company margins. And the extent that if companies can pass it through and consumers can absorb it, which is kind of the news that we're starting to get today, with the retail sales looking decent, it might be an environment where we can kind of muddle through, deal with some of the tariffs, and then sort of look on to next year.
And I know as an economist, obviously you're watching the big picture macro numbers. Are you also going to be listening to earnings calls or looking for signals from individual companies on what's going on?
Yes, we certainly will be. And this time it's going to be that much more important because the economic data certainly get revised quite a bit. They're, you just need it as part of the mosaic, and hearing from companies, especially how they're handling these tariffs, is going to be critical when we're thinking about what's going to happen with their margins, what are they guiding to in terms of CapEx, how are they feeling about the backdrop, and how are they feeling about their ability to pass it through? Because for a lot of companies, they're not even dealing with inventories that are subject to tariffs yet. But it's about their expectation into certainly the back to school season, and then into the Christmas season, to what extent they believe they can pass it through, because that will help us inform our forward-looking view about inflation, growth, and then of course what the Fed's going to do.
Yeah, I guess we're still seeing some of those weird inventory adjustments. I saw a headline this morning about Korean beauty products. People in the U.S. who are fans, like buying them like crazy and stockpiling them because they're not seeing the tariff effect on those yet.
As they should be.
Yeah.
I mean, if you know that you really like this product, we know it may or may not go up in price. Like, why not buy it now?
Yeah.
And we saw that from an autos perspective.
Right.
Consumers kind of got that, and they started to buy autos in advance of the tariffs. And automakers haven't really passed through those prices yet. They haven't really done that on a lot of other goods, just because it's a little bit hard to foresee that, and they're not such large, big, ticket items. Things that are more durable in nature, consumers did buy that in advance.
Yeah, getting your mascara, stocking up. Stephanie, thank you so much. And coming up, a look at some of today's trending tickers. Plus, can artificial intelligence bring new life to familiar companies? It already has. In some cases, will it keep going? One hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, Yahoo Finance senior reporter Alexander Canal. Ali, what are you seeing today?
Yeah, Julie. So I'm taking a look at stocks right now. We are mostly trading in a mixed picture at the current moment. We have the Dow Jones Industrial Average is in the green, and the NASDAQ, there we go on my screen right now. The Dow Jones is up around 0.2%. The S&P 500 is up around the same amount. And then the tech-heavy NASDAQ leading gains today up about 0.3% here. And I also want to take a look at the bond market, because this has been something that we have been aggressively focusing in on. We are seeing 10-year yields pause a little bit today. We are lower, still hovering around 4.4%. Strategists have told us that 4.6% is the one to watch. That's where we could start to see a bit of a pressure on U.S. equities there. And then also, if we take a look at 30-year yields, we are now below 5%. So a 5% level, another key technical level to watch. And then finally, let's take a look at shares of Netflix. This is one of the top trending tickers on the Yahoo Finance page. We are up about 0.4% heading into that earnings report that we'll be receiving after the bell today. The focus here is going to be on those heavy hitting shows coming out later this year, like Stranger Things. Wednesday, we saw the return of Squid Game last month. There just seems to be a lot of momentum for Netflix now heading into the back half of the year. And also the ad business. Any updates there? We will no longer be receiving subscriber figures, but a lot of analysts on the street have told us that that is a key area to watch, especially when we look at top line growth, Julie.
Now time for some of today's trending tickers. We're watching Lucid, railroad stocks, and Sarepta. First up, shares of EV maker Lucid popping after news the company is partnering with Uber and self-driving startup Nuro in a partnership that's planning to launch self-driving services in 2026. Uber, as part of this, going to invest $300 million in Lucid. That'll be used to upgrade its supply chain to install Nuro's software in its vehicles. Ali Canasta with me here. Those shares up 27%. I was just looking because I suspected it was pretty heavily shorted stock, and it is. About more than 30% of its float is shorted, according to data tracked by Bloomberg. So that's pretty high. So it could be a short squeeze here. But talk us through this story. And I mean, it's I guess a fairly surprising development for Lucid to come into this whole world.
Yeah, and we know robotaxis, this has been something that Uber has been talking about for some time, certainly a growth area for that business. And to that point, Uber stock is up around 40% since the start of the year. We're seeing a bit of a muted reaction today on the announcement, but again, not totally surprised there considering the aggressive growth that we've seen. But for a company like Lucid, even with today's pop, we are still down 3% since the start of the year here. So this is a company that struggled, as you were just saying, heavily shorted name. We know robotaxis in general have been a big catalyst for many companies. Tesla, for example, a lot of their Tesla bulls have been focused on its own robotaxi initiatives, autonomous driving. That seems to be the new frontier for a lot of these EV companies. So a good sign, I think, that Lucid is getting in on this action, but we'll see. The share price has just really struggled.
And let's talk about some railroad stocks, too. CSX, Norfolk Southern, they're rising after a report from Semaphore that their rival, Union Pacific, is eyeing a potential acquisition of one of these other companies, maybe, and has hired bankers to explore a deal. Now, if Union Pacific were to buy one of the East Coast-based railroad companies, the transaction would be worth in the tens of billions of dollars. CSX, its market value around $62 billion, Norfolk Southern around $58 billion. So this would be a big deal and big consolidation at a time when, you know, some of at least the cross-border traffic is a little challenged, Ali.
Yeah, and my first question here is regulatory scrutiny. You were just ticking through some of those numbers there. A deal of this size is going to have some regulatory hurdles. But if we are able to cross this bar, it would be transformative for the entire industry. As you were just saying, both of these companies have around a $60 billion valuation. The competitive dynamics, especially within the freight industry, would be completely changed. Taking a look at shares year to date, Norfolk Southern is the clear outperformer here. We're up around 14%. Today, though, it seems like CSX is just up a little bit more on this news here. So a another one that we'll have to continue to wait and see how this develops. But interesting to see this exploration here, as infrastructure focus has been a big priority. It was a huge priority for the Biden administration. We'll see what happens here, though, with Trump 2.0.
Yes, we will. And finally, pharmaceutical company Sarepta Therapeutics announcing it's going to be restructuring its business in plans that include cutting expenses and staff. About a third of its workforce will be eliminated, and $400 million in annual expenses will be cut in this plan. The company also announced preliminary second quarter results with lower than expected sales of $513 million in the latest quarter. On the flip side, it said one of its medications will remain on the market. There have been some questions around that, Allie, but those shares up 16% today.
Yeah, but year to date, even including these 16% gains, we're still down over 80%. I'm taking a look at the trading range, the 52-week range, $16.88 to $153.30. Wow. So that is just wild to me. Sarepta is committing to this cost-cutting plan. They plan to slash 500 jobs, prioritize lower priority gene therapy programs targeting $400 million in annual savings. So all efforts to stabilize finances here. So to me, this is a relief rally, but it doesn't really solve some of that core problems, I should say, with this company. There's investor concern around Elevidys. This is that high-profile gene therapy for DMD. That's a type of muscular dystrophy, and confidence in both that drug and the broader DMD platform has waned here. So if this execution is there on this restructuring plan, maybe we can see investors pile back into this name. But I think that's the next step here. We need to see them be able to execute on a lot of these efforts. But right now, looking at just the metrics here, the numbers, the chart, it doesn't look too good.
Yeah, and this is one, by the way, that is also relatively heavily shorted, Allie. Thank you. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Taiwan Semiconductor raised its full year guidance as it anticipates sales growth of about 30%. That's after a better than expected 61% jump in sales in the second quarter. It seems to show that hyperscalers remain committed to aggressive expansion into artificial intelligence spending. Joining me now, Paul Meeks, 17 Asset Management CIO and Water Tower Research Managing Director. Paul, it's great to see you. So we had TSM here coming out in contrast with ASML, which is a chip equipment maker, coming out yesterday and seeming to express that its clients are uncertain about orders because of the pace of tariffs. Then you get TSM today. So how are you thinking about the two in comparison with each other?
Well, they're both great companies, and they're both absolutely necessary in the semiconductor supply chain worldwide. I will tell you, though, Taiwan Semiconductor, being a foundry and not a capital equipment maker like ASML, does have advantages. The manufacturing, essentially for all the US-made designs, is something that will always put them first and foremost. Now, over time, I imagine that if Taiwan Semiconductor keeps up its pace, it is going to have to order at some point, probably not in the near term, but we'll have to order some extreme ultraviolet equipment from ASM. So they are at least somewhat drawn together, but I would not put them in the same camp. ASM is obviously telling us that they are uncertain about the look, not for 2025, but their outlook for 2026. But I expect no surprises and further upside, at least on revenue, from Taiwan Semi.
And when we look at Taiwan Semi, is what we heard from them today a signal to sort of about the broader chip industry, given that they still seem pretty optimistic?
Oh, for sure. And particularly the voracious demand for high-end computing, and particularly for their wafer designs under 7 nanometer, which is the length of the transistors. I will tell you that nobody else can do it. And Samsung, which was up until now the world's #2 foundry, has had some stumbles of late, particularly with their AI memory chips. So there is no company more important than Taiwan Semi on the planet. The only thing that I worry about with Taiwan Semi, it's not their fundamentals. It's this dude in China named Xi Jinping. And does the mainland Chinese ever decide to take Taiwan? But we'll see about that.
Yeah, we will see about that. I mean, is that something, when you're owning that stock, is that something that you need to sort of hedge against in some way?
I don't know if you can hedge against it, but it's obviously something that you have to consider.
Right, for
Right.
sure.
Xi Jinping may have the job for life. He's still a relatively young man, and he stated on many public occasions that before he steps down for power, he would like to retake Taiwan. So, yeah, that's kind of scary.
Yeah, definitely something to keep a watch on. Obviously, if you're going to buy that one, especially with the stock trading up at the levels where it is. There's another trend that I wanted to talk to you about, Paul, that I found interesting in the market recently, and that's, you and I have been following these tech stocks for a long time, right? And there's some, like Oracle, which we've been speaking about recently and watching, that have sort of found new life because of this AI wave. How much further can it take them?
Yeah, there are a couple of blasts from the past. I would say Oracle and AI, but I don't think Oracle and AI with its any kind of tilt towards a large language model or even its apps is the big deal. It's OCI, right? Their cloud computing infrastructure that's very much like Microsoft Azure and Amazon AWS. If it was just a AI hopeful software company, I wouldn't have the same view of Oracle. The other thing I think will be interesting is not today, not tomorrow, but sooner or later, quantum computing will explode. And then you'll see another blast from the past because here comes IBM. IBM, after all these years of being poo-pooed, could be a leader in quantum computing.
Well, and IBM is already trading near a record, so it's already been seeing a lift from some of the transformations that company has been undergoing. Are there other sort of like old workhorses that you think people should be holding in their portfolios because they're part of this new wave?
Yeah, another one that people had given up for dead was Cisco, right? For a long time, Cisco's growth had slowed, and the only reason that you would buy Cisco was it had a really high dividend yield for a tech stock. So you could get kind of a twofer and have a call option on some price appreciation. However, Cisco in this AI infrastructure world has some mojo. And I also think Cisco might be part of the consortium that is permitted in the United States to buy TikTok. So that could be interesting.
Right.
So yeah, another one.
Let's get to the biggie here, and that is, of course, NVIDIA. We had the recent news that they were going to be selling more, or that they were expecting to get the licenses again to sell H20s into China. What do you think is the biggest obstacle or risk for NVIDIA at this point?
Well, we know whether it's the Chinese or the dude that we have in the White House that, a policy could easily be changed from morning to afternoon. So I still worry about that. But in the meantime, I think things are going great there. And this quarter, NVIDIA was supposed to do revenues of about $45 billion. And that was excluding $8 billion in H20 revenue. So now that we're back on, it won't go from 0 back to 8. But think about it. This could add, and it should add to all the Wall Street models, 20% upside to revenues over the next year or so. So if this deal sticks, and I'm always worried about these deals sticking, but obviously a boon for NVIDIA, and I agree, post this announcement, the sell side is at about a $200 price target for NVIDIA. I think it's achievable.
Okay, we'll be watching. It's already trading at a record again today, and that market cap we've been watching so closely is at about $4.2 trillion,
Wow.
Paul. Yeah, exactly. That's all you can say. Whoa. Good to see you. Thanks for joining us.
Best wishes.
You too. We got much more coming up. Stay tuned. You're watching Market Catalysts. Alcoa shares are rising after the company posted second quarter results with a beat on adjusted EBITDA and sales. Adjusted earnings per share were in line with estimates. The company is seeing the impact of President Trump's tariff policies, resulting in a $115 million hit on imports of aluminum to the U.S. from Canada in the second quarter. They also see another $90 million hit in the third quarter. Here to break down these results is William Oplinger, CEO of Alcoa. Bill, thank you so much for being here. We really appreciate it.
Hi, Julie. Thanks for having me on.
So I know that this has been a big issue for you guys trying to navigate the tariff costs here. And you're expecting those costs to be mitigated a little bit in the current quarter. But first of all, big picture for our viewers, talk to me about how you're thinking about the tariffs and navigating around them.
Right. So big picture, it's important to understand that the United States is short metal currently. So we import into the U.S. roughly 4 million metric tons of aluminum every year, and approximately 3 million of that comes from Canada. So with tariffs that have gone up to 50%, that has raised prices in the United States significantly. So our customers are paying higher for aluminum in the U.S., 50% higher than anywhere else in the world. While prices have gone up, they have not completely covered the tariff cost of bringing metal in from Canada. Therefore, during the second quarter, we diverted shipments out of the U.S. into other parts of the world, approximately 100,000 tons, because the prices don't cover the entirety of the tariff costs.
Bill, what is the capacity in the U.S. to increase production, or would it need to really come with a big investment in increasing that capacity?
So we consume over 4 million metric tons of metal in the U.S. We import 4 million metric tons from the rest of the world. We make about 700,000, and we export around 700,000. So the U.S. has the capability of making is making around 700,000 tons today. There is some capacity that is offline, and that would raise the capacity to 1.3 million metric tons, but it still leaves the United States considerably short of metal. Over the next coming years, no matter what gets done, the U.S. will be short aluminum.
Are there sort of big plans in the works to build new capacity? We're seeing that obviously in a lot of industries, but it's something that takes time.
Takes time, takes money, takes energy. So in the case of aluminum, if you're 4 million metric tons short, it would cost $25 to $30 billion to replace that capacity in the United States. It's going to use around 6 gigawatts of energy. So you would need to build the equivalent of 6 of the latest nuclear reactors in the United States to support the energy requirements to reshore that 4 million metric tons in the U.S. So it will be time consuming and it will be expensive, and it's just simply not going to happen overnight.
Now, Bill, because of demand in the U.S. for presumably untariffed aluminum, right, that is at a lower price than the tariffed aluminum would be, have you all been seeing an increase in demand?
We have seen, we're projecting over the long period of time that some reshoring of our downstream customers will occur in both Europe and in North America. And that's related to shortening supply lines and potentially the tariffs. Our order book overall in both Europe and in North America has stayed pretty strong. So when I go market by market, our building construction business, which is the largest demand driver for aluminum, has not shown any sign of further weakening from where we are today. So that's good. The packaging business for the aluminum industry is exceedingly strong. Electrical cable is very strong. The only really subsector of the market that we are seeing weakness in is automotive, and we believe that's related to some of the tariffs that are going on, and we've seen some weakness in both Europe and in North America.
And what about the potential 50% tariffs on things coming in from Brazil? If that does go into effect on August 1st, what kind of ripple effect would that have on the industry?
So the industry for the U.S. imports almost all of its intermediate product, which is called alumina. Alumina is used to make aluminum. In the case of Alcoa, we import all of that from Brazil. Now we can direct shipments from our other alumina refineries around the world to meet that demand in the U.S. to avoid those 50% tariffs. That'll take time, and we have the capability of doing that. It's important to remember at this point those tariffs aren't in place and they're being discussed, but we would be in a position of diverting shipments from other parts of the world into the U.S.
And Bill, on that point, it's being discussed. What have you found in terms of the receptiveness of the White House to wiggle on this stuff that is clearly proving to be pretty onerous for your industry?
So we've had a lot of advocacy, both for Alcoa and the Aluminum Association in the U.S. I've personally been spending a lot of time in D.C., some time in Ottawa, ensuring that both sides of the border understand the underlying dynamics of the aluminum industry for the United States, walking them through some of the numbers that I just walked your listeners through, and explaining to them how short the U.S. is on aluminum and how long it will take to replace that. So we've had good reception from both sides of the border, and the focus has been education and trying to get them to understand exactly how important it is to keep those supply chains that are in place today and have been in place for decades between Quebec and many of our customers in the downstream.
Bill, thank you so much for your time. We appreciate it.
Thank you for having me. Appreciate it.
Up next, we'll focus in on those Pepsi earnings that came out today. Stay tuned. You're watching Market Catalysts. PepsiCo rising after topping second quarter estimates and reiterating its full year outlook. The maker of Lay's and Gatorade citing strong international growth for the results. Joining me now is Nick Modi, RBC Capital Markets Managing Director. Nick, good to see you here. You got a sector perform on this one. Price target of $146. When you look at the volumes here, kind of lackluster. What do you think is going on with Pepsi? What is your sort of biggest takeaway?
Yeah, I mean, look, this has been a general theme that's been going across the entire consumer goods space. Grocery inflation has outpaced wage growth, going back to when we got out of the pandemic. And I think that's made groceries literally less affordable in the eyes of the consumer. And so in those circumstances, the consumer looks for value. Now, when you think about what's happened to a bag of potato chips or Doritos or any other salty snack for that matter, the prices have gone up quite a bit. Or there's product that's come out of the package. And I think consumers have noticed, and so they're making choices. They're either going to private label, or they're maybe even going to protein-forward snacks, just given the rise of the interest in protein as we have an aging population, but also because of GLP-1s. So I think all of that is contributing to Pepsi's volume weakness. Looks like they're starting to reinvest back into promotions and drive some improved volume. So sequentially, it got better from the first quarter. But we still think they have a lot of wood to chop to get their business back to growth.
Does the stock price reaction today, that 6% boost, does that make sense to you?
Listen, the expectations were incredibly low coming into the quarter. And that's a function of many other food companies having very disappointing results. General Mills, Smucker's, Conagra, for example. So I think what's happening today is just a reaction to it being not as bad as everyone thought. But let's not kid ourselves. These were not good results in an absolute sense. And so we feel very comfortable with our sector perform at this point.
And Nick, we've seen a lot of changes in the food industry in terms of remaking of various conglomerates, right? Sort of splitting up, spinning off brands, et cetera. Is that what Pepsi needs to do also?
I don't think Pepsi necessarily needs to do that. I mean, I think a lot of Pepsi's issues are macro-driven. I think there's probably some strategic missteps they made around innovation. And I think they need to expand their product portfolio to include other snacking substrates like cauliflower and edamame, but also be more protein forward. So I don't really think they need to have any massive corporate action like you're seeing with some of the other companies in the sector right now.
Well, and you mentioned the macro. Is it just tough to be in the snack business right now because of those trends, or is it just a matter of they're not leaning into some of the micro trends that you alluded to, the sort of quote unquote healthier snacks or the protein forward snacks?
I think it's a little bit of both, right? It's hard to quantify what's structural versus cyclical, but I would say the cyclical element is very high because it's not just Pepsi that's struggling. Almost all of my companies across the entire consumer goods landscape are feeling volume pressure right now. So that's why I believe that this is a very big cyclical issue. And so as we start getting into a better, more normalized consumer environment, whenever that comes, I certainly think you'll see some volume improvement.
So we got to talk about then the big elephant in the room, the so-called Maha effect on this industry, right? The Make America Healthy Again, RFK Jr. Effect here. President Trump just saying in a social media post in the last 24 hours that Coca-Cola has agreed to stop using high fructose corn syrup, will transition to cane sugar in its beverages. Coke hasn't confirmed that it's doing that. Do you think this is where the industry is going? What effect is that going to have on margins, for example?
Well, it all depends on the tariff situation, right? One of the reasons why I think sugar was not being used in the U.S. is because it was a much higher cost of good than high fructose corn syrup. Now, interestingly, when you think about quote unquote Mexican Coke, right? This is the Coca-Cola that comes from Mexico into the U.S. in the glass bottles. That tends to do very well and tends to sell at a premium. So, I think there's some positive implications if that indeed happens. But it really is going to come down to what the cost of goods situation will look like as it relates to buying sugar and importing sugar into the U.S. market.
I mean, how big of a change would this be, when you're talking about a reformulation for the biggest products here? I mean, and presumably Pepsi would have to follow suit.
Yeah, I mean, I think it's just going to take a little bit of time to kind of get all the supply chains and all the manufacturing re-equipped. But remember, they already make the product. So it's not like they have to reformulate. They already have the formulation. They just have to produce it at scale in the U.S. market.
Would they have the capacity to switch over American manufacturing? Because as you mentioned, Mexican Coke, it's in the name. They import it from Mexico. Presumably they would still have to import the sugar, right? To your point about the corn is here already. What is that? How big of a supply chain changeover are we talking about?
I don't think it's going to be that abrupt. I think it is very manageable for them and their bottlers, which also would be part of that process. So I don't think that's really a big issue. Now, when it comes to artificial ingredients and things like that, obviously the entire food and beverage landscape are making adjustments, and that's a good thing, right? The reality is no one ever wanted to be first because you don't want some kind of optical disadvantage using a natural dye versus an artificial dye, for example. But if everyone has to do it, it harmonizes the playing field and brings ubiquity, and then I don't really think we'll see much impact as a result.
Really interesting perspective. Nick, thank you so much. I appreciate it.
You bet. Thanks for having me.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, economic evaluation. We'll talk retail sales, sentiment, and the labor market as the U.S. contends with a re-acceleration in inflation potentially. Plus, planes, trains, and cars. We'll talk about a new robotaxi partnership between Lucid and Uber and dive into United Airlines' full-year outlook. And housing hurdles. Home builder sentiment edging up in July. We'll discuss what that means for the housing market. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. First up, the major averages here, and we're seeing a little bit of an extension of gains in the NASDAQ in particular. Right now up 0.5%. The S&P 500 up about 0.25%. The Dow, the laggard here in today's session on a relative basis, but still it's up by more than 70 points as we watch this continuing rally here in the major averages. I believe that we are at another record high for the S&P and the Dow here with the gains that we are seeing today. Let's also take a look at the bond market here because we've been seeing yields move lower a little bit here, the 10-year at 4.43%. Now we're digging into some of the economic data that we got this morning. Retail sales coming in above expectations, rising 0.6% in June. Economists were looking for only 0.1% growth. Initial jobless claims falling for the fifth consecutive week. 221,000 claims was the reading. And back with me on this is Stephanie Roth, Wolfe Research chief economist. So we talked a little bit about retail sales earlier, Stephanie, but I did want to dig a little bit further into this because it's an interesting moment right now because we keep hearing the tariff increases are coming. There's still a little bit of trepidation about economic growth. And then you see a number like that. So how should we be, what does that number really mean?
Yeah, I mean, I would curb your enthusiasm a little bit about the print.
Gotcha.
The headline numbers are influenced by some of the more volatile categories. I would focus on the control group, which came in at a solid 0.5% month on month, but it did have some historical backward revisions. So I think the message from the consumer right now is they're fine. The consumer's doing okay in light of everything going on, so there's no major sentiment hit as a result of the tariffs. But there are some categories that were either it's an air pocket or there's concerns around higher prices. Things like furniture have been soft and are still remaining fairly soft. The muted rebound in autos was a little bit disappointing, but generally speaking, the bulk of the categories were just fine. So I would say the consumer is powering through this. They're doing okay. They might start to be a little bit softer just because prices are starting to rise, and we saw that earlier this week with the inflation data. And it's a little bit more difficult for the Fed to be cutting in September.
Right, interesting. Why is, just spell that out for us, why it's more difficult for them.
Sure. So the Fed is going to be focused on the two sides of their mandate, inflation and employment. So they're going to be looking at the inflation data, which we're now starting to see. The tariffs are working their way into the data. And June was probably the first month that we're really likely to see the impact of the tariffs on the data. July and August, it should be notably more significant. On top of that, air travel might be a little bit stronger in the next couple months because it's been quite weak for quite some time. And then on top of that, the employment side of the mandate is going to be important too. And that's going to be presumably the key factor here, because many were thinking that the unemployment rate was going to be rising throughout the course of the summer. In the most recent print, it actually fell. Right. And I think some of the dynamics here are, sure, the labor market is fine, but also immigration is putting a sort of a reduction in the labor supply. So now we have fewer workers, and that sort of puts some downward pressure on the unemployment rate.
Yeah, I mean, and the other, besides the rate, you can look at that initial jobless claim and number and continuing claims, and that also looks pretty good, right?
Yeah, it tells you that companies aren't really firing. Yes, the pace of hiring has slowed down. So this is something that's going to be sort of an interesting dynamic throughout the course of the next couple of employment prints. We're going to see much lower headline job numbers. So job gains could easily trend below 100,000 for the next couple of prints, yet the unemployment rate not really be rising. And this is a dynamic that the Fed certainly understands, and a big reason is because we don't have immigration boosting job gains as it has been in the past couple of years.
Yeah, and I'm really curious on that immigration front, that dynamic of, I think sort of the conventional wisdom around some of the jobs that immigrants and migrants have held is that they were jobs that sort of citizen Americans didn't necessarily want or were going to fill. Is it playing out that way? Are those jobs remaining unfilled in some cases?
Yeah, I mean, so the backdrop is such that they are blue-collar workers. A lot of them are in construction, retail, leisure, and hospitality. The one sort of offsetting factor is, yes, Americans, generally speaking, those are less, tend to be less desirable jobs. But especially since the youth unemployment rate is so high, these people who just graduated college might take some of these jobs, or they just graduated high school might actually step into these roles. And over the summer, that's when you tend to see those folks start to look for jobs again, so the timing might be kind of just right.
Interesting.
So as opposed to it being the Doge workers filling in these jobs, which is highly unlikely, the youths, people who are graduating high school looking for a job, they might just take these jobs for at least in the near term, especially if wages start to pick up there.
Yeah, as the mother of a 16-year-old who has been trying to get a job over the summer, I know how tight that market is. So what are you looking for then going into the fall? If we're getting this sort of seasonal summer effect, what do you expect to happen, and where do you see it where are we going to see it show up?
Yeah, so over the fall, I think we'll start to see the unemployment rate stabilize around 4.2, 4.3. Most recently it fell to 4.1, which I think is kind of unusually weak. I expect it to kind of stabilize slightly higher than where it is today, but nowhere that's concerning. We should see job gains continue to trend below that 100,000 level. And we didn't really talk about the dynamics within immigration. It's not massive deportations that's really driving this. It is about 1.5 to 3 million immigrants are going to be losing their work authorization. A lot of them have lost it, and then there's more to come. The Trump administration has ended a lot of the programs that Biden put in place, which in particular, people coming from Cuba, Haiti, Nicaragua, Venezuela, 500,000 work authorizations were effectively ended overnight at the end of May. So these are people who are currently legally working as part of the labor force and now no longer have the authority to do so.
What does all this mean for the Fed? Could we be in a scenario where the Fed doesn't cut at all this year?
Yeah, and that's our base case, is that we're going to be sitting here in December and the labor market's held up okay. Job gains have slowed down, but the unemployment rate doesn't rise that much. and inflation's a little bit elevated, and they just kind of wait and see. So the pressure on the Fed will probably continue to remain because if they're in this backdrop, they're not cutting, the Trump administration will probably not be happy with that.
All right, we'll check back in December. And before then, I'm sure. Stephanie, thank you so much. Appreciate your time today. We got much more markets action coming up. You're watching Market Catalysts. Uber is partnering with EV maker Lucid and autonomous software firm Nuro with a big bet on robotaxis. Joining me now with more details, senior autos reporter Pras Subramanian. Pras, this is such an interesting story. This might be one of my favorite ones of the day because, yes, Uber's been partnering with a lot of other companies, but it feels like a bigger deal or a bigger development maybe for Lucid because it feels a little unexpected.
Well, yeah, there's two sides here, right? So obviously Lucid, it's huge for them. I mean, look at the stock up 40% now. It's been surging since the open today. You know, Uber's going to buy 20,000 Lucid Gravity SUVs over the next 6 years to deploy this robotaxi service. They're going to use this company called Nuro that's going to power the level 4 autonomy. So the software from Nuro, cars from Lucid. Uber's going to invest $300 million into Lucid. That's a big, nice cash chunk there for Lucid, and a similar amount into Nuro for this to make this robotaxi service. And it's going to launch sometime next year in a U.S. city. I mean, look, great for Lucid, but also it's a big bet for Uber, right? They actually were at one time many years ago testing autonomous robotaxis, and they had to actually pull out of that business because of the deadly pedestrian incident a few years ago, but now they're back using strategic partners. Interestingly, Julie, Lucid and Uber have a connection. They're both two of the biggest holdings by the Saudi Arabia's PIF investment fund.
Oh, that is interesting. You have to wonder if they played a matchmaker role in this one. Just a quick follow here on Lucid. Different than the other sort of robotaxi stuff we've heard about. I mean, Lucid is a higher end vehicle compared to many of the others, right?
Yeah, to me, it seems interesting because this is going to be the Gravity SUV is actually a high-end luxury car. It starts at $80,000. Obviously, they might make a more stripped-down version for the service, but I think it's going to be aimed at more maybe a higher-end consumer. Maybe it'll launch in more upscale cities. It seems like that's the case, or at least they're betting on Lucid's technology, which is pretty high-end in terms of state-of-the-art technology. From drivetrain to battery efficiency, things like that, very, very comparable to Tesla from that point of view. So I think it's sort of a bet on maybe the higher end part of that robotaxi business. We'll see.
Interesting. Yeah, the pricing in particular will be really interesting for those rides. All right, we got to turn to another topic. Pras, you and I have been talking a lot about European automakers recently and the varying effects of tariffs and how they've been doing. We got Volvo. So it reported earnings for the second quarter. What can you tell us about those results and whether the CEO said anything about tariffs?
Results weren't that great, better than expected from a Wall Street analyst point of view, but they actually swung to a loss, demand issues, other impairments. But some of the bigger things are that they're facing that 25% tariff from EU-built goods, but then also 100% tariffs from China because they built some of their sedans there. And what's happening now is Volvo's going to now pull back some of those products like those sedans and wagons, focus more on those upper-end SUVs, even build some of them like the XC60, very popular mid-size SUV in the U.S., kind of rejuggling or reshifting the kind of portfolio here to focus more on U.S. goods. Also want to note that Volvo's new CEO, Hakan Samuelsson, the guy who actually returned to the company, actually have some choice words for the EU, saying that the EU should get rid of their tariffs on U.S. autos right now, make it, as he called them, unnecessary, make it a more level playing field. So they want to actually, because he wants to make a deal. He needs the U.S. tariffs to come down because he's saying the EU tariffs don't really matter because U.S. goods don't really compete that well in Europe anyway.
That is very interesting. Also, given some of the rhetoric we've gotten from European Union officials about changing the business environment there. Pras, thanks so much. We'll see you in a minute. Now time for some of today's trending tickers. We are watching U.S. Bancorp, Ethereum, and Roblox. Yahoo Finance's Josh Schaefer is joining me now to discuss. And first up, we've got U.S. Bancorp. Profits surpassing expectations in the second quarter. Adjusted earnings per share of $1.11. That's a 14% increase from the prior year. But net interest income did miss some estimates, clocking in at just over $4 billion. Analysts were looking for $4.11 billion. This is the first earnings report for the bank under new chief executive Gunjan Kedia. The shares are down about 2% here, Josh.
Yeah, Julie, I mean, it really seems like that net interest income story is kind of what's driving the stock, right? So there was an analyst over at Truist, John McDonald. He pointed out it's a, quote, tough optic is what he called it. When you look across the banking sector, net interest income has not really been a problem industry-wide, right? And so there are multiple variables that could impact a metric like that, but it's not like this is some sort of interest rate story that's weighing on the sector as a whole. So it becomes a little bit more of a U.S. Bancorp story, and that weighs on your stock a little bit. And the stock going into the report hadn't, or you could see there over the last 3 months up 17%, but if you zoom out over the year to date or the last year, it hadn't really been acting that well either, not like some of the other larger banks like JP Morgan or something.
Right,
like
some of the big banks have really been outperforming here. Let's talk about Ethereum, because it is at a 5-month high, soared past $3,400 as a number of crypto-related bills have been making their way through the House of Representatives. The House voting on 3 bills that, if passed, would constitute a major win for the crypto industry. I mean, there's been some back and forth on those bills, but and we talked to somebody from CoinDesk earlier in the week who pointed out it's not just Bitcoin that's been rallying; it has been a broader crypto rally.
Yeah, this was something we were talking about earlier this morning too on Market Sunrise, just sort of zooming into the fact that it's interesting. We talked earlier this week, Bitcoin hits 122,000, right? Another record, here we go, Bitcoin. But if you zoom out and look at the rally in Ethereum, even the rally in Solana, those coins have actually been rallying more than Bitcoin as of late. So you're starting to see that trade maybe broaden out. And then, of course, you have famed investor Peter Thiel investing in BitMine, which is a firm that's related to Ethereum in some ways, right? A Ethereum-centered treasury sort of strategy. And I don't know, I just wonder, are people now with Bitcoin back at a record high, is it getting into the crypto sort of trade that we've seen before where it's like, okay, where should I go next?
Yeah.
We've had this stablecoin conversation, there's been the Circle trade, and it's just, if outside of Bitcoin, where is there still more opportunity, maybe potential growth, trying to maybe chase the trade?
Yeah, and it's interesting that company has an Ethereum treasury strategy, because we keep talking about companies putting Bitcoin on their balance sheet. So why not the other stuff too, I guess, in some situations. And finally, let's talk about Roblox. It's rolling out new safety features, including a tool that can measure age based on video selfies. This is intended to protect its kid-heavy user base. The platform is introducing a new tier called Trusted Connections that allows people to talk via text and voice calls without the filter that censors certain words, but you have to be 13 to use the feature. This has been an ongoing issue for Roblox, right? Because their selling point is that they are a safer platform, but there are ways of getting around some of their protections.
Yeah, and it seems like an important step for Roblox, right? And again, thinking about just what this stock has been up to, stock's up over 100% this year, which I did not realize until I started doing some research on this. So analysts continue to come out and be overall bullish on this name too. Yesterday, JP Morgan analysts moved up their year-end price target to $125 from $120, citing more platform engagement, inflecting higher. Hopefully those are people that are of age to use the platform, right?
Well, anybody can use it.
Yeah.
It's about who you can, I know this from personal experience. Anyone can use a Roblox. And Roblox, of course, is just a platform where there are a bunch of games on Roblox. It is who you can communicate with and how you can use the platform that is supposed to be age restricted.
It's interesting. Yeah. And I mean, we really buried the lead here. There's AI now that can guess how old we are if it looks at our faces. We got to try this just in general.
Is that surprising?
No, but I think this is like an experiment. I'm curious
and
about.
for people who are not teenagers, like, will it flatter you?
We're going to test this. We're going to test this out offline, Julie, and we'll see if we get older or younger.
All right, let's do it. Thanks, Josh. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, we got more markets action, including a focus in on earnings from Novartis. Stay tuned. Nearly 2 hours into the trading day, let's get a check on the markets here. We are seeing a little bit of a rally take hold and kind of extend as well. There's the Dow. Right now it's up just over 120 points here, about 0.25%. The S&P 500 up about 0.4. The NASDAQ has been leading gains. It's up about 0.7% here. And then switching on over and taking a look at some of the sectors that are on the move here today. We've got healthcare that is really weak here. Elevance, Abbott Labs, some of the drags there after those companies reported earnings. But then we've got the XLK, that is infotech that is higher, as well as industrials. Breaking on down and taking a look at the NASDAQ 100 movers here as well today. Seeing some early strength in the likes of Microsoft, Nvidia trading at another record, but so is Broadcom shares. Those shares up around 2% today. Overall, a mixed picture, which is not unusual to have on an earnings day. And speaking of earnings, PepsiCo PepsiCo catching my eye here. The dark green that indicates that it's up quite a bit today. It is up 7% on the back of its earnings news. When you look at the Dow here, you also see some strength here in the largest members of the Dow, of course, price-weighted index versus market cap-weighted index. But interesting to see those movements there as well. And then also, since we're talking transportation here, taking a look at the transports on an intraday basis, seeing a pop in some of the railroads after a report by Semaphore that Union Pacific, might be looking to buy one of its competitors. So you see CSX and Norfolk Southern in the middle of your screen there. And then United, which I started to mention, out with its numbers after the close of trading yesterday, and those shares gaining some 3%. Let's talk a little bit more about that one. United Airlines narrowing its profit range for the year as the company's CEO says the world is less uncertain than it was during the first 6 months of the year. Joining me now, Yahoo Finance's Pras Subramanian and Mike Boyd, Boyd Group International President. Pras, let's start with you. What are the biggest takeaways from these results, and what is the outlook for the second half of the year looking like?
Well, I would say mixed messages here from United. I mean, we saw that they cut their guidance here, right, to the lower end here. It's saying the consumer is weak at that economy level. They have a heavy international business and others. I think Mike can probably talk more about that. But also want to note that Newark, right, they're one of their biggest hubs. Newark constraints there are hitting margins. Adjusted pre-tax margins are going to hit by 1.2 points in Q2 and another less than a percentage point in Q3. But Newark volumes are returning to normal, they said. And CEO Scott Kirby talked about how the world is less uncertain here, right? He said more upbeat about the second half. But why the guidance cut then, right? Why are we cutting guidance? We think that there's going to be a return there in the second half. This is in stark contrast to Delta, which reinstated guidance and really was very upbeat about their business, focused on the higher end market, right? So mixed messages here. Maybe they're managing expectations, but I guess it's an okay quarter by United, but they're kind of sort of in between here trying to say, hey, things are okay, but we have some issues here with some of that lower end consumer and possibly international travel.
Yeah, I guess it's not the worst case scenario, but it's not the best case scenario either. Mike, you're a longtime airline consultant to the industry, focused on operations as well as other things. When it comes to the operational issues that United have been having at Newark and elsewhere, how do you think they're doing?
They're doing fine. The fact is, Newark has always been Newark, and United Airlines a few years ago, I think, probably in retrospect, made the mistake of pulling out of Kennedy. They're trying to get back in. But the real message here is Scott Kirby, and Scott Kirby is reading the tea leaves very well in terms of where the air transportation industry is going. He knows now, and he's doing a great job of it, of applying the network strengths, the advantages that United Airlines has in the marketplace. Take a look. He understands premium revenue counts, but he also says that delivery of the product also counts, and they're doing an outstanding job of that. Because the days when Southwest could just cut a fare, or Spirit could cut a fare, or someone could cut a fare and compete are over. He knows that, and I think what we're seeing here is adjusting to the new realities of the air transportation industry. That's, I think, the bigger issue than whether or not they made 1.2 or 1.3 billion this quarter.
Okay, Mike, talk to me a little bit more about what you mean by that. What are these new realities where you can't just cut a fare to get somebody on board? In other words, people have to have a good flying experience? Is that what you're saying?
No, absolutely. But a good flying experience is also an issue of being able to get to Bangor more than twice a week. Things like that. The bottom line with United Airlines is they're leveraging their network now, their ability to deliver people all across the country, and they're also looking internationally, which is fair. Patrick Quayle there is doing a tremendous job finding markets that U.S. carriers aren't in, like Malaga, places like that. But out of Washington, Dulles, they can fill up airplanes, 3 or 4 times a week to get to places like that. They understand that this is a new air transportation industry, and the days of having ultra low-cost carriers cut into your margins are over. They're struggling to survive.
Hey, Mike, you mentioned those ultra low-cost carriers. I think some people like Ed Bastian talking about how there's an overcapacity issue there with those budget airlines. Do you think that consolidation is possibly in the future, or maybe even the loss of an airline or two?
Well, the consolidation has already taken place in the effect of Spirit, parking, if you will, 24% of their capacity. But there's going to be more. You hit on a very good point here, because even carriers like Breeze, they're trying now to refugee themselves by flying to Florida. That's not going to continue to work. And you hit a good point. There is an overcapacity there. We already said where Avelo dropped their West Coast operation. They're a great operator. but they couldn't make it. So that extra capacity is going to be there. So I don't see any Studebaker-Packard mergers happening here. I just see pullbacks.
Hey, Pras, I want to ask you about the business travel part of the equation as well, because when we're talking about the premium tier, that is a part of it and part of the return of that. What do we hear from United on that front?
I mean, he said something, I think his terms were less uncertain is what he said, and that he says the second half is poised for some growth there. So I think he's hinting at that. But, it was a little bit more sanguine compared to what Delta was telling me last week about how they really see that. The fact that the Trump administration has put their tax bill in place, they're making trade deals, and that they were saying that led to more confidence for the business consumer and the wealthier consumer to buy air travel and to travel both for business and pleasure. So I think there was more positive takeaways from that. United was a bit more cautious there, and I think it's because they don't necessarily focus so high on the business traveler.
I was going to say, Mike, who sort of owns the business traveler?
The business traveler has to get from A to B. And keep in mind, a lot of business travel is no longer necessary. A lot of short-haul business travel from 20 years ago is now being done by this modality we're using right now. So the real issue is going to be the business traveler who's taking the long haul, the business traveler who's going international. They demand more, and they're going to be getting more from carriers. And Americans moving in the same direction, but United's probably a year ahead of them. So for the business traveler, can I get there and can I get back without wasting a lot of time waiting for schedules? United is leveraging their network to do that.
And you mentioned international. What are we seeing on that front right now, Mike?
Well, I think, everything is uncertain. I mean, yeah, you're right. I mean, Captain Smith, after they hit the iceberg, he's had a much more certain environment to face. But I don't think we're at that right now. We're looking at a situation where, there's a lot of secondary markets out there. Now, if what goes on in the Ukraine might spread, I'm very, very concerned. We watch China a lot. That uncertainty out there could do a number to all trans-Pacific traffic. But right now, I see the real growth is what United Airlines is doing, which is leveraging its hub system here to carry more U.S. traffic to their partners in Europe as well as their partners in the Far East.
While we have you, Mike, we want to talk a little bit about Boeing here. And I'm seeing it looks like an interview that Scott Kirby's doing. He says Boeing is back on track.
Boeing's back on track to deliver the much delayed 737-10s that are, 2 years late. And maybe should say thank you for that because they didn't need that capacity at the moment. But Boeing's back on track for now, but Boeing is not back on track for the future. They don't have any follow-on product. Their system is still a mess. We have a situation where Airbus has just totally leapfrogged them, and they're going to have to do something going forward because they got no platform, single-aisle platform beyond the 737 that anybody can see right now.
Mike, good to see you. Pras, thanks so much. Take care, guys.
Thank you, sir.
Coming up, the outlook for home builders. Stay tuned. Homebuilder confidence rose slightly in July with the National Association of Home Builders Housing Market Index rising to 33, up from 32 in June. The index has remained in negative territory for 15 months straight. Here with more on the outlook for home builders is Jim Tobin, NAHB CEO. Jim, it is good to see you here. So a small improvement, I guess we'll take it, right, in this environment. What do you think drove that improvement in confidence?
Well, good morning, Julie. I think we're bouncing along at the bottom here. I think one point up, which is great to see us to move in any positive direction. Really, I just think we've reached the bottom. And I travel across the country speaking to home builders in every market in every state, and there's still a level of confidence in the market, even though things have slowed considerably over the last couple of months. I also think the news out of Washington with the passage and enactment of the One Big Beautiful Bill Act, I think that sets the business and individual taxation in this country ahead for the next 10 years. I think that is a positive aspect. Plus the deregulation that President Trump is starting to implement. I think there's some good signs on the horizon. We're just stuck in a high interest rate and still a regulatory environment that's hurting home building.
Hey, Jim, in that bill, can you point to some specific stuff for people who might not be, I guess it would be difficult for anyone to be familiar with all of the intricacies of the bill, but in terms of the parts of the bill that are most relevant for your industry, what can you point to that could potentially be helpful?
The vast majority of homes built in this country are built by small and medium-sized businesses. So locking in that 20% deduction for pass-through entities to keep them competitive with the corporate rates, that is a huge deal, and that has been made permanent. So that's great for the business side of the home building industry. For consumers, they didn't touch any of the housing tax incentives, meaning the low-income housing meaning the mortgage interest deduction or the exclusion of capital gains on the sale of a home. But also, we've also created the pathway to build more low-income, affordable rental units, allowing people to get into safe, decent, affordable rental, and then build a nest egg so they can move into home ownership. So there's a lot in there, both from the business and individual side for housing. And again, setting the tax structure of this country for the next 5 to 10 years, a really big boost for the industry. And I think as we see that move into the economy over the next several months, that's going to add to more optimism for our industry.
How much of an offset of that, Jim, is that for the tariffs that have been increasing costs and could further increase costs for your members, as well as some of the immigration changes that have maybe put some stress on filling jobs within the industry?
Those are the two headwinds right now for us that I think have added to that uncertainty that have kind of flatlined home production in this country for the last several months. Tariffs will add costs to the building materials. We import about 7% of our building materials in this country. While those, the tariffs, we've had tariffs implied and then they've backed off. We're still hopeful and optimistic that the president is absolutely going to get these trade deals done and bring some balance to international trade and keep those prices low. But tariffs have created uncertainty. And then, of course, we consistently face a labor shortage in our sector, over 200,000 jobs short month after month, year after year now. The immigration crackdown certainly is adding a little bit of headwinds to our industry. And again, a very tight labor market. But then also, some crews aren't showing up on work. There have been enforcement actions. So we need to move on to a large-scale immigration policy reform in this country, and we're hopeful that President Trump will lead that effort.
One of the other things in this survey that really stood out to me is I believe you had the highest ever percentage of home builders cutting prices, 38%. What's going on there? How long can something like that, how long can that kind of a trend be sustained?
Well, we've got to move product. I think, we have seen inventories rise, especially in the new home sector space out there, as existing home sales continue to be very, very tight due to rate lock. So we've got to move this product off the street, so to speak. So I think you're going to see those price decreases continue for a little while until we get to the point where rates fall enough where people re-enter the market. I'm hopeful that we'll see the Fed lower its rates sometime in the third and fourth quarter. We continue to call for that in our forecast. Again, optimistic that the Fed does that, sends a signal to the broader economy that inflation has been tamed and that we're on a better path towards some economic growth in the future.
Jim, thanks so much. Appreciate it.
Thank you.
On the other side of the break, we'll speak to Novartis CEO Pras Narasimhan. He's joining us to discuss the company's latest quarter and forecast. That's next when Market Catalyst returns. Swiss drug maker Novartis boosting its full-year profit outlook after strong second quarter revenue growth driven by continued demand for key drugs. Now, despite the forecast boost, those shares are trading slightly lower. Let's talk about all of this, talk about the quarter and the outlook. Novartis CEO Pras Narasimhan is with me now. Pras, it's good to see you.
Good to see you as well.
Thanks for being here. So let's get to the forecast first. Then I want to talk a little bit about what's going on with the shares today. You guys, like many of your peers, pretty much all of your peers in the pharmaceutical industry, you are facing competition from generics down the line, but raising the forecast. What is driving your optimism and your confidence in that raised forecast?
Yeah, thanks, Julie. When you look at the first half of the year, we've had really strong momentum on our key growth drivers, which is underpinning our ability to have the strong sales growth that we have, but also leading to stronger profit performance. When you look at our breast cancer medicine, Kisqali, performing really strong in both early and metastatic breast cancer, Our prostate cancer drug Pluvicto with a new indication also performing really well. Our Semblix, a medicine called Semblix for chronic myelogenous leukemia, another type of cancer, also doing extremely well. So we have these launches really performing at a high level. Our existing brands are continuing to show dynamic growth. And then our productivity programs are allowing us to raise that bottom line guidance. It's our 10th bottom or top line raise in the last 10 quarters in a row. So I think that really shows the consistency of the operating performance.
One of the things I saw some analysts talk about in the quarter, which may be why the shares are under a little pressure, was sales of Cosentrix, which is your psoriasis medication, a little bit weaker than estimated. You talked on the call a little bit about maybe seeing some weaker demand out of China. Can you give us some more details on that and how sustained you think that's going to be?
Yeah, I think with Cosentrix, it's kind of a short-term, long-term story. In the long run, we're absolutely confident we'll get to our $8 billion peak sales and can consistently deliver mid-single-digit growth. We have seen a period of time over the last 4 or 5 quarters where Cosentrix has performed really well, and that's been driven by 2 things. One is performance in China, and 2, a new launch of a new indication in a type of dermatologic disease, hidradenitis suppurativa, which was really driving the performance over the last year. What we've seen in China is a slowdown. I think sector-wide, there's just more cost containment right now in China with respect to healthcare, and that led to slower growth in China than we've had in recent quarters for Cosentrix. And then in the U.S., we've had more rebates as part of the normal mix of things that happens in the U.S. with Medicaid and some of the other discount programs, as well as a new competitive entrant came in this HS indication. But, I think this is a short-term topic. I think we're going to have Cosentrix continue to grow this year, and we'll be back on track to get to that $8 billion outlook. And I think it just demonstrates that Cosentrix has been so consistent now for over a decade. This is just what investors expect, and we'll get back to that soon.
Gotcha. Let's talk tariffs a little bit, because earlier you did say, you told journalists that the new tariffs will not affect your guidance. Can you give us a little bit more details on that, kind of what your manufacturing footprint looks like for those who are not familiar, and how you're navigating that?
Yeah, absolutely. So for this year, because normally we carry 6 months of inventory for all of our key medicines, we have adequate inventory in the U.S. prior to any of the tariffs being enacted, that we don't expect that the tariffs have any impact on our guidance for 2025. And then for the medium term, our goal is through a $23 billion investment plan to build manufacturing capacity in the U.S. for all of our key medicines. We do make a few of our key medicines here in the U.S., but we need to expand that footprint so that all of our key medicines are produced in the U.S. for the U.S. We're expecting to be able to complete that in the next 3 to 4 years. We've already signed leases for new research sites, broke ground on 1 new manufacturing site with more to come. So we feel like we're on the right track, but that's going to be really critical because we know the administration is quite focused on pausing tariffs, at least that's what we expect, if you demonstrate you're actually actively moving that production into the U.S., and that's what we're planning to do.
Oh, that's interesting, boss, because, obviously we've gotten sort of vague indications from the president. He has mentioned a 200% tariff on pharmaceuticals, but he's also talked about maybe a 1-year phase-in period. But are you, as much as anybody can be confident in anything when it comes to tariffs, what's your confidence level that you will have a little bit more time before something that onerous would be imposed?
So I can't really predict, I have to say, as you know, it's very difficult to know. But that said, I think we're confident that as long as we're demonstrating progress, hopefully we can manage the imposition of these tariffs. We need about at least 3 years, but probably closer to 4 years to really move production fully over. So we're hopeful the administration sees that. And as long as we can demonstrate concrete milestones in terms of building out that capacity, that gives the confidence that we're serious about this and we will get there. But you're right, we'll have to see. We haven't seen the exact policy. We don't know exactly what the expectations will be, and we'll have to navigate it once we see that.
And Voss, you'll be navigating it without your longtime finance chief. Harry Kirsch is going to retire in March of next year. He's been with the company for 12 years. Do you foresee any kind of impact that's going to have on your this leadership change on your financial strategy, especially since you're going to be navigating some of these tariff headwinds?
No, not at all. I mean, I think this will just be a great opportunity for continuity, if anything, at Novartis. Harry will, at that point in time, have been CFO for 13 years. And I think that's a normal time point for someone to want to perhaps pursue a next chapter, new opportunities. So this is part of, I think, a very structured process. We have an 8 to 9 month now handover. Harry's successor, Mukul Mehta, has been with Novartis since 2003, knows the company extremely well, intimately aware of our strategy and our financial approach, capital allocation, et cetera. So I think this will just be more of a continuation of where we've been financially, a very balanced approach to capital allocation. We invest in our core business. We have a strong and growing dividend in Swiss francs. We do BD&L and M&A as appropriate when there's attractive things happening, and then we do share buybacks. And today we announced another $10 billion share buyback, having just completed a $15 billion share buyback earlier this year.
Right, definitely good to mention that. Finally, I want to ask about Ernesto, your top-selling heart drug, which is facing patent expiration. And I know you've talked a little bit about some legal challenges to that expiration in the United States. What more can you tell us about that and how you're incorporating that into your forecasts?
Yeah, absolutely. So we had always guided that Entresto would go off patent or have a generic competitor in the middle of this year. So that's the basis of our 2025 guidance, as well as our midterm guidance of a 5% plus growth out to the end of the decade. So that's all baked in. Now we do have a temporary injunction against the lone generic player who we don't have a settlement with, and that's being played out in the courts. And so any additional month we get would lead to $300 million or more of additional sales and profit for the company. But we guide based on the expectation that the generic could launch at any point in time. And we'll have to just see how the court cases play out. But we're absolutely comfortable with both our 2025 and midterm guidance, independent of what happens now with Pras. So anything we get now is an upside.
Vas, thanks so much. Good to see you.
Thank you. See you soon.
And that does it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.